Welcome to The Explainer. Today, we are literally putting on our detective hats and performing a total, framework-by-framework financial autopsy on Sunstone Hotel Investors. We're going to look way past the surface-level noise and completely break this stock down to its fundamental core. Here's our roadmap for today. We'll grab a quick company snapshot, view it through the legendary analytical lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, run our own quantitative DCF and dividend math, and then synthesize a final verdict. All right, let's dive right in. Section 1. Company Snapshot, Sunstone Hotel Investors. Let's get the basic facts down to really ground our investigation. Right now, Sunstone is trading at $11.43 a share. They operate as a lodging real estate investment trust, or REIT for short, that owns stunning luxury properties. Just think about the sheer physical, tangible value of the high-end real estate they control. So their whole business model, it's built on actively owning really well-located resort real estate. We're talking 14 hotels, which is roughly 7,000 rooms, under premium brands you definitely know, like Marriott, Hilton, and Hyatt. And operationally, they've actually got some real momentum right now. Their Q1 2026 total revenue per available room, that's RevPAR in industry speak, bumped up 7.4%. Plus, they're sitting on over $700 million in pro forma liquidity to play with. And they pay a steady 36-cent annual dividend. That's a yield of about 3.15%. Section 2. The Warren Buffett Lens, Moats and Owner Earnings. Let's see how this company holds up against the strict criteria of the Oracle of Omaha himself. Okay, so we all know Buffett absolutely loves an economic moat. And honestly, Sunstone's premium assets, especially their geographically restricted waterfront and luxury resort properties, those provide a massive physical barrier to entry. I mean, you can't exactly just build a massive new resort next door, right? But here's the catch. The hotel industry is highly cyclical, and historically, the profitability is kind of modest. That directly conflicts with Buffett's absolute obsession with high compounding returns on capital. Let's dig into the actual metrics. On the management side, they've done $108 million in recent share buybacks. Buffett loves that kind of honest, shareholder-friendly capital allocation. For his favorite metric, owner earnings, we can use their reported 2025 free cash flow, which is roughly $168 million, as a really solid proxy. Debt, highly manageable at 3.5 times net leverage. But there's a glaring issue for Buffett here. That forecast return on equity, or ROE, is just too low. It totally fails his strict test for high returns. So what's the bottom line for Warren? Because of that margin volatility and the low ROE, he'd demand a really steep margin of safety. There is no way he's biting at the current price. Looking at the data, he'd likely hold out for a price way down near the lowest analyst target of $9 before even thinking about a buy, just to make absolutely sure his capital is protected from those cyclical downturns. Moving right along to Section 3, the Peter Lynch Lens, Growth and Categories. Time to shift gears and use Peter Lynch's growth-oriented framework. Now, Lynch famously sorts companies into specific categories to really understand how they behave. So we have to ask, what is Sunstone? A fast grower? A stalwart? A turnaround? Or maybe something else entirely? Well, looking at Sunstone, it actually fits a pretty rare dual classification. On one hand, it's undeniably a cyclical because, let's face it, corporate and leisure travel are super sensitive to the broader economy, but at the exact same time, it's an incredible asset play, purely because of the sheer underlying value of its premium luxury real estate portfolio. And this perfectly explains why Lynch might actually be a big fan of this stock right now. Get this, they have a massive 77.7% forecasted earnings per share, or EPS, growth for 2026. They're jumping from 8 cents to 15 cents. If you take their price to earnings multiple and divide it by that huge growth rate, you get a wonderfully attractive PEG ratio. Pair that with a rock-solid balance sheet and over $170 million returned to shareholders in 2025, well, a Lynch-style analysis actually points to a really strong hold, maybe even borderline buy at today's price. Section 4. The Benjamin Graham Lens, Deep Value Mechanics. Let's strip away all those rosy growth forecasts and run the numbers through the strict, totally unforgiving criteria of the father of value investing, Benjamin Graham. Okay, let's run his famous defensive investor checklist. Sunstone definitely passes on adequate size, clocking in at roughly $1 billion in expected 2026 revenue. It passes the dividend record test for sure, and it actually passes the moderate price to book test, trading at $11.43 against an estimated $10.08 book value. But, and it's a huge but, it totally fails his strict test for long-term uninterrupted earnings stability. Remember, their EPS dropped 47% in 2025 before this current rebound. Graham would hate that. Let's crunch the numbers on his classic intrinsic value formula. We take his standard baseline multiplier of 22.5, multiply that by the expected 2026 earnings of 15 cents, and then multiply by the book value per share of 10.08. Take the square root of that whole shebang, and what do we get? An intrinsic value of exactly $5.83. Wow. That means a strict, deep value investor like Graham wouldn't even look at this stock at $11. He'd demand a massive 50% price drop just to establish his margin of safety. Section 5. DCF and alternative valuations. All right, time to leave the historical gurus behind and plunge right into the hard, quantitative math to build our own base models. To build our base case discounted cash flow model, we've got to map out their recent free cash flows. They crushed it with $167.9 million in 2025. But we have to factor in an expected dip in 2026, down to around $118 million. Why? Mainly because they're making some really heavy targeted reinvestments into flagship properties like the Andaz Miami Beach and Wailea. Now, since we don't have their exact internal cost of capital from the text, we're going to assume a standard 9% weighted average cost of capital, or WACC. That's pretty typical for what a mid-cap hospitality REIT pays to finance its assets. We project those cash flows out 5 years, tack on a conservative 2% terminal growth rate to match historical inflation and room rates, and then discount it all back to today. The result? A base case fair value of roughly $10.80 per share. But look at this sensitivity matrix. It shows you just how incredibly dependent this whole valuation is on macroeconomic interest rates. If the cost of capital drops to 8% and growth slightly beats expectations, boom, the fair value jumps to over $13. But if rates stay high and push that WACC up to 10%, the fair value sinks right back down into the $9 range. Let's try a secondary approach, the dividend discount model. If we factor in their 36-cent dividend and its recent 5.88% growth rate, and we use that same 9% cost of equity, well, this yield-focused approach gives us a much friendlier fair value of $12.22. That actually suggests the stock is slightly undervalued at today's market price. Section 6. Synthesis and final recommendation. Okay, it's time to bring all these distinct viewpoints together into one cohesive verdict. What should we actually take away from all this data? So, here's our final fair value scorecard. Our quantitative DCF and the analyst models, they're hovering right around the $10.80 mark. The dividend model sits a bit higher, up at $12. Interestingly, the retail community is way more bullish, pricing at around $13.50. Meanwhile, strict old-school deep value guys like Graham are basically waiting for a massive crash down to under $6 before they'd even consider stepping in. Blending all of this together, our expert verdict is a solid hold. Look, the company has incredible balance sheet liquidity and absolutely beautiful, highly desirable physical assets. But those thin operating margins severely limit their upside flexibility if the broader economic conditions soften. Peter Lynch might actually buy the growth here, but Buffett, he's definitely waiting for $9. At $11.43, it's fairly priced. It's just not a screaming bargain. Ultimately, the data shows us a company going through a pretty heavy transition. So I'm going to leave you with this question to guide your ongoing research. Is Sunstone effectively upgrading its portfolio for a massive cyclical breakout, or are they just trapped in a permanent cycle of heavy reinvestment and modest profitability? Thanks for joining me on this explainer. Keep researching and stay curious.